Hello, my name is Ajay Kumar. I'm an accountant, a CPA at Sai CPA Services. Today, we'll talk about qualified opportunity zone. How do we defer taxes? How do we avoid paying taxes at all by investing money into qualified opportunity zone? What's the difference between qualified opportunity zone versus qualified opportunity property versus qualified opportunity fund? When should you invest? Why should you invest, and how you should invest money to defer capital gain taxes? But let's take a step back. Go back to the history for a second here. What used to happen when you had large capital gains by selling a property, by selling a business, you were allowed to reinvest that money to avoid, to defer capital gain taxes. But under TCJA Act in 2017, Tax Cut and Jobs Act, what happened, this whole situation was limited to real estate. Now, if you have gains from the stock market, if you have gains by selling the business, you cannot really reinvest those gains and defer the taxes. That's where the capital gain taxes are created and opportunity zone becomes more important. 1031 exchange now after TCJA is limited to real estate property. So what happens if you invest money into qualified opportunity zone, you don't have to pay taxes, and there are rules around it, and there are situations when you can and when you cannot. But let's take a step back first. Let's understand what qualified opportunity zone is and how you should go about it. So in the whole country, there are some underdeveloped area. So if you invest money into those areas, let's say for example in New Jersey, there are certain portions of Newark, there are certain portions of South Jersey that federal government has identified, designated those areas as underdeveloped, qualified zones. So the idea is, if as an investor, you invest money into these qualified zones, and we call it qualified opportunity zone, then you can defer, and probably depending on how long you have to invest the money, you can avoid paying capital gain taxes altogether. You can't really go there and start investing money yourself. I mean, you can, but you have to have significant amount of money to be investing into these zones, these designated areas. The next concept comes in qualified opportunity property. Let's say if the state or the municipality is making a building over there in qualified opportunity zone, that project is a building, is called qualified opportunity property. You can buy certain stocks or bonds against the property, or invest some portion into that property and defer taxes or not pay taxes. So it was too difficult to identify those properties. It was difficult to go about investing money into such areas. So a lot of smaller firms came up with this idea of funds, qualified opportunity fund. They are privately managed funds where you can invest money, and ideally these funds are investing at least 90% of their collected money into these qualified opportunity zone, into qualified opportunity properties. So buying a portion of the qualified opportunity fund makes it easier for the investor to invest into qualified opportunity zone, qualified opportunity property. So the idea is, and it's a win-win, the way the government looks at it, you invest money into qualified opportunity zone, you get some tax benefit, and these opportunity zone, these underdeveloped areas gets developed. You have to keep the money in that property, in that fund, in that area for at least 5 years. If you don't keep the money invested for at least 5 years, you don't get any capital gain benefit. But if you keep the money in that qualified opportunity zone for at least 5 years, your cost basis increases by 10%. What it means is, the first 10% of the gain you don't have to pay taxes on. If you keep the property for 7 years, you get another 5% benefit. If you keep your money in the qualified opportunity zone, the whole capital gain can be avoided. Meaning, if you keep the money in the qualified opportunity fund for at least 10 years, you do not have to pay any capital gain taxes at the time of selling this property, or at the time you take the money out of this qualified opportunity fund. There are risks associated with it. In theory, like anything else, your money is invested and the property did not do as well, or the property valuation fell down. So it's not risk-free investment. Please consider the risk associated with it. Please check the reputation of the fund you are investing in. Please make sure you do your homework to check the area, the property that you are trying to invest in. The idea here is that capital gains can be avoided by investing money into qualified opportunity zone. This idea was not as popular prior to 2017 only because a lot of people were able to invest money into the real estate to defer the gain. Now, since that 1031 exchange is limited to the real estate property, if you have gains from the business, if you have gain from the stock market, you have to pay the capital gain taxes. For last couple of years, this qualified opportunity zone idea has become hot. So please do your research, make sure you know the risk of your investment and consider investing into qualified opportunity zone. Again, my name is Ajay Kumar. I'm an accountant, a CPA. For any question, please feel free to call me or write back to me.